Welcome to the May update for the Hopkins Group Managed Discretionary Account portfolios. We had our investment committee meeting on Thursday last week, and the main discussions from an economic point of view centred on the US debt ceiling, which is in negotiations between the Democrats and the Republicans. We expect them to get a deal done, but again, it could just be an extension of the current limit for a short period of time, or it could be a longer term deal. But it does create some uncertainty in markets, and you're seeing some of that volatility now. And certainly if no deal is done, it is going to have a big impact on the portfolios, with the expectations that the US won't be able to pay Social Security and fund its workings from a government perspective, which would obviously be pretty negative for markets in the short term. Here in Australia, sort of the big issue has been an uptick in unemployment, and while it's only a small uptick, the uptick in unemployment is typically a lagging indicator. You're seeing a downturn in housing starts, and you're seeing other economic indicators that potentially could precede a recession here in Australia. So we're keeping a really close eye on those sort of economic releases to give us an indication about what impact it's going to have, and whether Australia is actually going to fall into a recession. So those are the things that we're watching, and we are on higher alert around a potential for that. In regards to what impact that those two factors have on the portfolio, we haven't made any changes to the portfolio this month. We're still of the view that a neutral to slightly conservative position in the portfolio is warranted. We're not sort of panicking about sort of recessions and those sort of things at this stage, in that we don't expect markets to fall significantly, but keeping an eye on those economic indicators, is really important, and being ready to act when and if we see something that will use to protect your money within the portfolio is what we're looking for. So the portfolio really performed pretty well during the April period. So we got a good boost from the growth within the portfolio, and a couple of those growth managers that had exposure to high quality tech, which has rallied strongly. So we've had that sort of within the portfolio, and we've also got some benefit out of the value holdings as well. I mean, I think with that US banking crisis and that sort of thing, companies within the value space benefited from sort of perhaps money flowing out of the banks into the other areas, particularly in the US. The other areas that have performed pretty well within the portfolio were the Aussie value and the Aussie broad index portfolios, which again benefited from the economic environment here in Australia and the strength, and perhaps some of that sort of risk off as exposure to Asia and Australia. The one area that obviously hasn't performed as well is sort of that private equity space, which has come off a little bit. Perhaps again a little bit of profit taking out of there and moving some money to other areas. So the broad portfolio though is sort of that neutral area. Perhaps with a bit of growth orientation, which is going to continue to hopefully perform well for us within there. One area that we are looking at is that fixed interest area very closely. So we've still had floating rate exposure there, which benefits from interest rate rises and benefits from expectations of interest rate rises. But similar to some of these economic indicators, we are keeping a really close eye to move perhaps towards more of the fixed rate bonds and the fixed income, so that when interest rates do start falling and the expectation that they're going to start falling, that you're going to benefit from any uplift in capital in those areas. So it was a really robust discussion that we had during the investment committee, and it continues to provide a really challenging environment currently, and we're certainly on heightened awareness, and certainly the investment consultant is doing a lot of work behind the scenes to make sure that your capital is protected, and the preservation of your capital is there if things are going to change. One of the situations in reality though is that, you know, we could already, you know, be in a technical recession, and you don't sort of find that out till 6 months later. So, you know, and markets have historically rallied during recessions. So they bottom out during a recession, so and then rally upwards, and you don't necessarily find that out. So it's a really challenging time in markets, but we think we've got a really good balance that if markets do rally from here, we're going to get the benefit from them, and that we're also, you know, relatively conservative in our approach to portfolio construction, so that if markets do fall, you know, your capital will be preserved, and we're at heightened awareness to make changes if our view of the markets change. So, you know, I guess the message is that, you know, things are, you know, we're constantly reviewing the portfolio, making sure that we're preserving the capital as best as possible, and obviously would benefit from any upside in markets as well. So, you know, your money's being well looked after and the stewardship's, you know, really high quality. So thank you for watching the video, and look forward to giving you an update next month.